Equities have been smoked over these last two sessions, as you can see on your screen here. The S&P is down roughly 8.5% over 2 days. Now, as we all know at this point, it has been the hotter than expected CPI reading from Friday that has really upset the apple cart, so to speak. If we flip over this chart here, you can see the VIX, that is the Equity Volatility Index in blue, against the U.S. 10-year yield in orange. And as you can see, again, as the CPI reading came in hotter than expected, yields surged and the VIX spiked, which tells us that equities crashed. Now, the issue here is that the Fed is going to come out on Wednesday and set a new rate, and the market has had to rapidly reprice their expectations of what the Fed may do because of this CPI reading. Just to give you an idea of what has happened here, this ocean blue color, as I would call it, shows us that roughly there was a 76% market probability of a 50 basis point rate hike to a target rate of 125 to 150. Now what has happened is the market just today has now decided that the probability is 90% for a 75 basis point rate hike. So as you can see, the expectations of what the Fed is going to do has shifted rapidly, and this has implications for assets basically writ large, right? Credit markets, FX, currencies, equities, you name it, all have to adjust to these changing rate expectations. And so what has happened, obviously, again, back to equities, is that we've had a really rather large sell-off. Now, from our perspective, from the options market perspective, we have a very large options expiration, which we have been pounding the table on for several weeks here. There are going to be very large put options expiring on Friday, June 17th. That is 2 days after the FOMC. To give you an idea how big these put readings are, on your screen here, we've posted a ratio of S&P put gamma relative to call gamma. And as you can see, this little green dot down here tells us that the put position in the S&P is as large as it has ever been. This is going back to the debacle of March 2020 and the big sell-off in December of 2018. And oftentimes what happens is, when you have these big put positions, we believe dealers who are short puts are also short a lot of futures and other short delta hedges, basically. So what happens is, as expiration takes place, put options expire, big put positions expire, and dealers can cover some of those short hedges, and that can spark a rally in markets. That is why in March of 2020, we believe we got this extra sharp bounce in the market. Same thing with 2018. And if we shift back to this chart here, you can see that just this past January, we had big in-the-money call positions expire, right? Market rallied after that. And then right into the March of this year, the March FOMC was also tied to a very put-heavy options equity expiration, and we had a giant 10% rally there. So what's interesting in this case, again, is we're going to have the Fed come out. They're going to do what they do on Wednesday. And that is setting up this interesting timing of the market possibly cratering into that Friday options expiration, in which case we will look for a bounce in markets on Monday and Tuesday as options roll off, as these put options roll off. Conversely, if the Fed is somewhat benign and traders read the Fed as a little bit less hawkish than anticipated, we could get a rally into Friday as those short cover hedges, basically that short rally fuel, is pulled forward a bit, and we rally into Friday. So we are looking for something of what we call a path-dependent rally into Friday or possibly on Monday and Tuesday. But the big thing to note here, the more macro picture, is that ultimately what this is doing, this expiration is doing, is it's removing put hedges from the market. And so if you zoom out, what that tells us is that as the market was well hedged heading into this Friday, we are no longer going to be as well hedged. And we think that ultimately that will lead to lower lows heading forward. But again, we are looking for a short-term bounce, as we detail in our subscriber notes. To this point, if you want to ride through the next week with us, you can get a free trial. If you go to SpotGamma.com, hit subscribe now. Free 7-day trial of our product. We're going to be putting out 2 daily notes, one in the morning, one after the close, and our equity hub, which shows you the options positions on over 3,000 different stocks. If you have any questions, please put them in the comment section below or hit us up at SpotGamma on Twitter.